Hello and welcome to Smart Finance Investor. Today, we're diving into a crucial topic for investors: how to analyze a company's financial health. Understanding a company's financial well-being is essential before making any investment decisions. Whether you are a beginner or an experienced investor, this guide will equip you with the tools to assess a company's financial health effectively. Why analyzing financial health matters. Understanding a company's financial health matters because it's like examining the vital signs of a business. Just as you wouldn't invest in a physical health plan without understanding your body's condition, you shouldn't invest in a company without assessing its financial well-being. Analyzing financial health helps you gauge the company's stability, growth potential, and ability to weather economic storms. It reveals the efficiency of its operations, its debt levels, and its cash flow patterns. This information empowers you to make informed investment decisions, spotting opportunities and risks. It also offers insights into the company's management effectiveness and strategic decisions. By studying financial statements and ratios, you gain a comprehensive understanding of the company's performance and can determine whether it aligns with your investment objectives. Ultimately, analyzing financial health is a fundamental step to ensure your investments are grounded in facts and logic, minimizing the potential for surprises down the road. Step 1. Understand financial statements. Financial statements are the company's financial story, providing a snapshot of its performance and position. The balance sheet details assets, liabilities, and equity, showing the company's financial position at a specific time. The income statement highlights revenues, expenses, and profits, illustrating its profitability over a period. The cash flow statement reveals how cash is generated and used, reflecting the company's liquidity. Understanding these statements enables you to track trends, identify strengths and weaknesses, and assess financial health. Key financial ratios like debt to equity and current ratio are derived from these statements and offer insights into risk levels and operational efficiency. By deciphering financial statements, you gain a solid foundation to analyze a company's operations, assess its ability to generate profits, and make informed investment decisions. Step 2. Assess profitability. Profitability analysis involves evaluating a company's ability to generate earnings from its operations. Key profitability ratios include gross profit margin, which measures the percentage of revenue left after deducting the cost of goods sold. Operating margin assesses the profitability of core operations, factoring in operating expenses. Net profit margin reveals the portion of revenue that translates into net profit after all expenses. These ratios provide insights into the company's efficiency in controlling costs and converting sales into profits. Analyzing profitability helps you understand how well the company manages its resources and whether it can sustain earnings growth. A company with consistent and healthy profitability ratios often indicates strong operational performance and the potential for long-term success. Step 3. Examine liquidity and solvency. Liquidity refers to a company's ability to meet short-term financial obligations. Key ratios like the current ratio and quick ratio assess the company's ability to cover its short-term liabilities with its short-term assets. Solvency, on the other hand, evaluates its long-term financial stability. The debt-to-equity ratio measures the company's reliance on debt financing and its financial leverage. A lower ratio indicates lower financial risk. Analyzing liquidity and solvency helps you understand whether the company has the resources to meet its obligations and whether it's structurally sound in the long term. A balance between liquidity and solvency is crucial for a company's financial health, ensuring it can navigate both immediate needs and future growth while managing its debt burden effectively. Step 4. Evaluate efficiency. Efficiency analysis focuses on how well a company utilizes its assets and resources. Ratios like inventory turnover, receivables turnover, and payables turnover assess how quickly the company converts inventory, accounts receivable, and accounts payable into cash. Higher turnover ratios often indicate effective management. Efficient utilization of resources minimizes tied-up capital and enhances cash flow. Additionally, the asset turnover ratio evaluates how efficiently the company generates revenue from its total assets. Evaluating efficiency provides insights into the company's operational effectiveness, management of working capital, and potential for optimizing its operations. By understanding these ratios, you can identify whether the company is effectively managing its resources and generating optimal returns on its investments. Step 5. Analyze cash flow. Cash flow analysis delves into the company's ability to generate and manage cash. The cash flow statement reveals the inflows and outflows of cash from operating, investing, and financing activities. Operating cash flow reflects the core operations cash generation, while investing activities highlight capital expenditures and asset sales. Financing activities cover debt issuance, dividend payments, and equity transactions. A positive operating cash flow is essential for sustaining operations and investments. Analyzing the cash flow statement provides insights into the company's liquidity, financial flexibility, and ability to fund growth. A company with healthy cash flow can weather economic downturns and seize growth opportunities, making this analysis critical for assessing its financial health. Step 6. Compare to industry peers. Benchmarking a company's financial performance against its industry peers provides context for its relative strength and weaknesses. By comparing key financial ratios, such as profitability, liquidity, and solvency, you gain insights into how the company fares within its sector. Ratios that significantly deviate from industry averages may indicate areas of concern or competitive advantage. Analyzing relative performance helps you understand whether the company is efficiently managing resources and operations compared to its competitors. This perspective assists in identifying outliers and potential areas for improvement. Keep in mind that industries vary, and a nuanced analysis considers the specific dynamics and challenges within the sector when drawing conclusions from peer comparisons. Step 7. Look for red flags. Vigilance in spotting potential warning signs is crucial in analyzing a company's financial health. Unusual fluctuations in key financial metrics, declining profitability, increasing debt levels, and irregularities in financial statements can be red flags. Investigate any inconsistencies that might signal underlying issues or mismanagement. Scrutinize the notes to financial statements for contingent liabilities and commitments. Pay attention to significant changes in accounting methods or estimates. Conducting a thorough analysis helps uncover hidden risks that may impact the company's future performance and value. Identifying red flags allows you to make well-informed decisions and avoid potential pitfalls in your investment journey. In conclusion, analyzing a company's financial health is a crucial step in your investment journey. It helps you make informed decisions, mitigate risks, and uncover investment opportunities. By understanding financial statements, assessing profitability, examining liquidity and solvency, evaluating efficiency, analyzing cash flow, comparing to peers, and being vigilant for red flags, you equip yourself with the skills needed to navigate the complex world of investing. If you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Until next time, happy investing.